30 minutes until the start of trading after an all-new record high at the close last night. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up at Takeover Tuesday, Anglo American buys Canada's Teck, creating a more than $50 billion company in one of the biggest mining deals in over a decade. Meanwhile, over in Cupertino, Apple is set to unveil its first major new iPhone design in several years. Ed Ludlow is there for us. And BLS data due out in the next hour may show another big jobs markdown, setting the stage for a Fed rate cut that we frankly already expect.
And is, let's be honest, already priced in.
Yeah.
I'm looking at some other moves that are not priced in, because you might look at a stock like Nebius and say, what even is that? Well, Microsoft tapped them to help power their AI compete through 2031 from a data center in New Jersey. That deal could net Nebius $19 billion. Matt, at one point, this company was actually a Russian company and got sanctioned. So what a comeback for Nebius.
Yeah, and an amazing climb. Obviously, in today's session, shares of Teck Resources are soaring as well. Not quite that much. We're looking at a 17% gain pre-market. This after Anglo American agreed to acquire the Canadian miner. The deal gives Anglo access to Teck's much coveted portfolio of copper mines after a period when it has itself been an acquisition target and faced pressure from its shareholders. We're going to get much more on that deal right now.
Let's do it, Matt. We are joined by Bloomberg managing editor for commodities, Simon Casey, on this story. Simon, it's a big deal in this market. It's been called by some a zero premium merger. How attractive is that really for Teck to accept something like of that nature?
Well, it depends who you are. If you're Teck management, it's attractive. You get to stay in Vancouver. The enlarged company is still going to be based there. It's essentially a Canadian-based mining champion. I think if you're a minority Teck investor, it's questionable. As you say, it's a complicated structure. I won't go into it too much here, but it's not much of a premium for minority investors.
Yeah, that is weird. And it took me a second to read through the structure and figure out what's happening. It is kind of a 17% premium, but it looks like Anglo is also kind of paying their own shareholders to accept the deal.
That's right. I mean, very unusual. So let's see how that goes down with investors. We're still trying to reach out to a lot of those investors. I think they're still digesting it this morning. Look, we've seen nil premium mergers in other natural resources over the years, especially in oil and gas. Whether this one will go through, I don't know, because there have been other interests as well in Teck, as we know, and in Anglo too. Both companies have attracted interest in the last couple of years.
And there are fascinating clauses as well that leave both open to a higher, either one open to a higher bid if it comes. Simon, great to have you with us this morning. Simon Casey runs a commodities coverage for us here at Bloomberg. Now, let's get to Teck. Microsoft struck a deal with cloud computing company Nebius to help power its AI efforts through 2031. Nebius will get up to $19 billion from the agreement. It was formerly known as Yandex, a Russian tech giant that broke up following the start of the war in Ukraine. Bloomberg Tech co-host Carolyn Hyde joins us now here on set. So this is another story about a target that has been in question, right? What do we know about Yandex?
Well, Yandex still exists in Russia and is owned by Russian investors now, and it's still the number one place to go on the internet, whether it's e-commerce, whether it's search, whether it's buying ride-hailing. It's sort of your super app in Russia. But this Russian entrepreneur has moved completely away from it. And I'm talking about the man who's now set up Nebius, and he's all in on AI infrastructure, also cars, robotics here in the United States and Europe more broadly. This is a company that is now listed in Germany, and the founder is Arkady Volosh. Now, he has once been sanctioned by the EU, but once he condemned the invasion of Ukraine, he moved away from Yandex. He set up Nebius as a holding company and now is fully integrated into providing for smaller startups, but also big enterprises and now hyperscalers the AI data center requirements that they need. He's basically the neo player at the moment when you talk about neo cloud. That is what D.A. Davidson analysts are currently saying. They're really excited about this offering, and this is all about 19 billion up to 19 billion. It's going to be 17 billion with an option to do $2 billion more, and it's all coming from New Jersey. Vineland is where it's likely to start coming up with the AI infrastructure as soon as next year.
What an incredible comeback story from being
and what
sanctioned
a story.
to this. It is wild. Caroline, elsewhere, we are going to get Oracle earnings after the bell today. It's been a couple days of a run up in this stock. I feel like everybody yesterday and their mother was upgrading. Oracle, where is the bar for them today?
High, because the shares are up 40% year to date. This is another story in the same way that Nebius is getting along with the insatiable demand for AI compute. Oracle made that nice pivot, got into AI infrastructure and has won. We're seeing likely this year to see a 70% increase in revenue for that particular part of the business, the cloud AI infrastructure part. On this fiscal quarter, it's their fiscal first quarter, we're likely to see about 56% growth there. You're likely to see revenue all told up about 13%. But is that going to be enough to live up to the hype that is already priced in? The fact that shares are up 40% year to date is pretty phenomenal. It's one of the best performing stocks in the S&P.
Yeah, about $20 under the record high, too. So we might get there after today. We'll see what it brings. Caroline, thank you so much for joining. Appreciate it. That's Caroline Hyde of Bloomberg Tech. Now, this afternoon, speaking of tech, Apple is set to hold its biggest product event of the year. It will unveil the new iPhone 17 lineup and other devices. Joining us live from that event in Cupertino, California, is Bloomberg Tech co-host Ed Ludlow. Ed, what are you expecting for today?
Yeah, you're right to frame it as the biggest event of the year, because the frank reality is that iPhone still accounts for more than 50% of revenue. And as Matt alluded to earlier in the program, in this generation of iPhone 17, according to Bloomberg's reporting, we're likely to get something major in terms of a refresh or development, and that is the iPhone 17 Air, an ultra-thin phone, 5.5 millimeters of thickness, according to our reporting. Important in the context of competition because Samsung came out with the S25 Galaxy Edge this summer. But depending on when these latest generation handsets go on sale, we're currently in the fiscal fourth quarter. It's all about the timing around the holiday season. And for all the political noise around tariffs and Tim Cook's relationship with the president, this is the bread and butter, and it's why it matters. The iPhone 17 range more generally, Pro and Pro Max at the high-end base model, improvements to camera, custom silicon, updated generation of processor, and battery life, all of these things matter. And as you guys know, often this is a sell the news kind of event for the stock. But look 30 or 60 days out. And if it's a success and it resonates with consumers, often that carries a longer-term rally for the stock as well.
All right, so what do we know about the main product, the phone? What are we going to see? I saw the phrase awe-dropping, which doesn't make any sense at all, right? It's either awesome or jaw-dropping, but I love the portmanteau.
Jaw-dropping.
What's going to be in the iPhone 17?
So on the sort of more negative side, Mark Gurman's reporting at Bloomberg on the 17 Air is that to get that ultra-thin phone, whether it resonates with consumers or not, you sacrifice battery life, have a more basic camera, and it has an A19 processor on it, not the highest end or cutting-edge processor. On the Pro and Pro Max side, innovation in camera technology. This is something that is very important to track because it is something that resonates with the consumer, with the developer, and then A19 Pro processor, custom silicon and performance comes into it. What's missing, of course, and I think that's kind of at the root of your question as well, is like, will we hear anything about artificial intelligence based on what we heard at WWDC with Apple Intelligence and Mark's reporting on a revamped Siri? Siri, probably not until the spring. So the features at the higher end of these phones are important. Then there's the issue of tariffs and pricing.
Ed, you teased this last time we talked to you, but perhaps the last time Apple shares actually moved when it came to announcement was at WWDC. When it came to an AI announcement, how much did these product launches really matter for share prices?
Yeah, you know, we debate on Bloomberg Television all the time, like, does the tick by tick really matter? There was a moment at WWDC where essentially executives said, we will have more to say about Apple Intelligence and Siri later, next year, and the stock took a market leg lower. This data that we're showing on the screen is critically important. It's inspired by research from Bank of America, which shows essentially on the day itself, often Apple shares sell off. It is a sell the news event, as we discussed. But when a handset generation does resonate and does well, particularly in that holiday quarter, 30 days post-event, 60 days post-event, you do tend to see a positive reaction in the shares. Dan Curtis on our terminal team put this chart together custom because the left-hand column 2 months before is more interesting. Actually, all of the enthusiasm and excitement going into the event often results in outperformance of the stock prior to announcement of the handset. That's how high the bar is. So it actually takes quite a lot in the features to move the needle in the stock. But again, there are some big macro supply chain and political questions that we'll try to answer along the way as well.
And of course, we're all just excited to see the tech. All of us who live in this Apple ecosystem. Ed Ludlow out in Cupertino is going to be there to show it to all of us from Bloomberg Tech. That kicks off at 11, and he'll be reporting from Cupertino at this awe-dropping event all day long. Ed, looking forward to it. Let's get a quick check of what's going on in futures this morning after closing at an all-time high yesterday. I believe 65.11 was the level on the S&P. We're looking at a slight gain, but we need more than that to make it up to the level we saw yesterday. NASDAQ futures up a little bit more, but only 0.1%, and the small caps, Dani, are down.
It's down probably because bond yields are higher, but bond yields have been falling over the past 5 days, even though you've had an S&P that has just barely kept up 0.5%. Maybe this will also move the needle too, Matt. Coming up, the BLS under pressure ahead of U.S. jobs revision data that's due today. We're going to look at the issues plaguing the department and the figures we are going to be getting in about 50 minutes time. That's all coming up next. This is Bloomberg Open Interest. The BLS revisions data will be released in the next hour. Just as it comes to this economy, it may reinforce the view of a U.S. job slowdown. On the political front, it might be used as more ammo to say something is broken with the BLS. Joining us now is Michael McKee, Bloomberg's international economics and policy correspondent. Let's just start with the data first, Mike. What might we expect today?
Well, this may be the most inconsequential data for the labor market and the markets that we have seen in a long time because of the politics you're talking about. BLS every month surveys about 34% of all jobs. Once a year, they re-benchmark that using tax data, actual data, as opposed to survey data. In March of 2025, the BLS estimated that we had 159,275,000 jobs in the U.S. The benchmark estimate median is that will be reduced by about 700,000 jobs. The range is 200,000 to 900,000. In 2024, the preliminary estimate at this time last year, 818,000, but the final estimate, it was revised down by 589,000. So this is only a preliminary guess at a preliminary estimate. It's sort of like if you'd surveyed the Chicago Bears game last night and asked people what the score was going to be at halftime. Did it really matter at the end?
Well, they're all just depressed they're getting moved out of Chicago, right? Aren't the Bears going to
they are. They are.
Yeah, sorry, completely separate.
Well, also, because that game wasn't finished at halftime, right? This is data that's backward looking, right?
It's backward
looking. And by the
looking.
way, they continue to revise down drastically.
Yeah.
What's either wrong with the models or the personnel at the BLS that they always overestimate, like analysts at earnings season?
Well, they don't always overestimate. There are some years in these revisions where they're revised higher. The problem is it's a survey, and over the years it's gotten a little bit less reliable in its initial estimates, low initial response rates, although by the time you get to the second revision, they're up to about 95%. The pandemic caused data-related issues in terms of seasonal adjustment. Companies changed their hiring patterns. There's severe understaffing at the BLS. They have 20% fewer employees than they had in January, thanks to DOGE. 12 of 25 top leadership positions are vacant at the BLS, but they can't hire anybody because there's a federal hiring freeze. And then for years, they've suffered significant ongoing budget cuts. So it's hard for them to put in some new systems. Now, this all looks really terrible, guys, but I want to show you a chart here. It looks bad. 818,000, as I said, total payrolls was the initial report last year at this time, which would have been 0.5 percentage point of total jobs in the U.S. And you can see down the list there in the various categories how small these revisions are in the context of the overall labor market. So it's going to sound terrible, and it's going to provide some people with political fodder, but it isn't really going to be significant, and the Fed already knows what's going on with this, and they're not going to be changing their views about what to do on next Wednesday based on this data today. They're looking, as Matt said, this is back data. from March of last year backwards. They're looking at what's happening right now.
Well, to that point, Trump has been posting on Truth Social this morning, talking about the data, saying that the Fed, the entire organization is broken. It needs to be fixed. They need to use modern sources of information. We strongly disagree with Ken Griffin, who, by the way, had penned an op-ed saying that independence is important. Trump goes on to say, we think incompetence is more important than to defend theoretical independence. If we do get a confirmation of Trump's pick for the BLS, and they are pushing them to make changes, to have different data that the Fed should instead be analyzing, what could they actually do, Mike? What differences could we actually see at the BLS?
Probably not a whole lot, unless the president and the Congress are willing to go along with increasing budgets and giving them the resources they need to make changes. They are already adopting alternative data sources. That's been going on for several years. The Fed has a number of alternative data sources, and it may be that if Stephen Myron goes in there to argue with the Fed, he might learn something about what they're doing. But if Stephen Myron goes in there on Tuesday for the first time, he's not going to have much of an impact because it's a short-term appointment. Only if he were there longer could he raise a stink in public. But again, he might learn something.
It's so amazing how many names the president checked in this tweet, right?
Yeah.
You mentioned Ken Griffin, which is, I guess, the third biggest name in the tweet, because he also mentions the Pope and Jesus Christ. But he says he was watching, I guess, Jay Hatfield, Infrastructure Capital Advisors CEO, who is a frequent guest on this program, Maria Bartiromo, he mentions a couple of times, Greg Farinello. So it's a jam-packed tweet.
It kind of reminds me of the list of Fed chair candidates, that there were so many names that they were looking at, and the kind of qualification for all of them was, do they think the Fed should be cutting rates, and do they think Fed should be cutting rates in a big way? So they have plenty of economists to pull from.
Yeah, a lot of interesting stuff. Mike, thanks so much for joining us. Bloomberg's Michael McKee is our international economics and policy correspondent. Coming up, Allspring's Ann Miletti says equity valuation is a poor timing tool for investors. We'll talk about her strategy next. This is Bloomberg Open Interest.
The Magnificent Seven account for 30% of the S&P 500, and they have a multiple of about 30 right now. And the rest of the market's got a valuation multiple of 19. Not cheap, but that it's the impressive 493. They're doing pretty well. Just by comparison to the Magnificent Seven, they look a little punky. But all in all, I think we're still looking at a bull market.
Ed Yardeni on Bloomberg Surveillance this morning. Joining us now is Allspring's Global Head of Equity Investments, Ann Miletti. Ann, great to see you this morning. So you have Ed Yardeni that's still bullish, but if you wanted to make a bearish case, you could kind of easily do it. You could say valuations are really high, credit spreads are really tight. As the labor market slows, as the economy looks iffy, as the fiscal picture looks iffy, can you still be bullish at this point on the equity market?
I think you can be, as long as you're willing to be a little uncomfortable. And more importantly, for me, it's important to think about relative risk versus reward and where you can get that in the market. And I think Ed Yardeni made some interesting points there. When you look at the market averages, for certain, we're kind of at historic highs by almost any measure. But when you look underneath those averages, there still are some attractive areas to invest.
So basically at the index level, you'd be a little bit more cautious. Where do you like in terms of maybe industry groups or factors to invest?
Yeah, when I look at it, certainly down cap looks more appealing to me than some of those larger cap areas. And so whether that's the mid cap or small cap, so like this mid cap area is kind of the most attractive to me. And I think that's just because on a relative basis, they have been pressured by a higher interest rate environment that has fueled that large cap space.
Yeah.
And yet there's a lot of innovation happening in that marketplace and across industries there.
Yeah, well, we'll get more into the details in that when the market opens about 4 minutes time. And you're going to stick around with us, Ann Miletti of Allspring. A quick check on futures ahead of that opening bell. We are moving just ever so slightly higher, a tenth away from all-time highs. Will we get there today? Your opening bell coming up next.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. I mistakenly said we closed at an all-time high yesterday because I was looking at Dani's futures.
Oh, it's all my fault, eh?
Well, no, I'm just saying. So at that time, futures were at 65.11. We actually closed below 6,500 yesterday just. You can see right now futures are back up only 0.03% to 65.07. So we'll see what the cash trade settles out at. We need to get over 65.02 for an all-time high. You hear the New York Stock Exchange closing bell. You see, I guess, members of the board or management at Train Technologies. This company is absolutely crushing it. They're only up like 12 or 13% this year, but they're up like 278% over the past 5 years. So very happy faces there. Down at the down at the NASDAQ market site, you do see CNBC, members of the Squawk Box team. There's Andrew Ross Sorkin, there's Becky Quick, there's Joe Kernan in the back. They do a pretty good job also. Sometimes I watch. They had a really good interview of President Trump, I thought.
They did. I feel very uncomfortable with how meta this whole thing has got. Like, you're watching Bloomberg, watching CNBC on our screen, so I'm going to move on swiftly from that, Matt.
Yes, let's
All
do
right,
that.
some stocks to watch for you this morning. Microsoft has tapped Nebius to help power its AI compute through 2031 from a new data center in New Jersey. That deal, a coup for Nebius, could net them $19 billion. The reaction has been huge, Matt, up 50%. What are you looking at?
Yeah, I'm looking at Anglo American. It's going to buy Canada's Teck Resources, which is, you know, a target that a few other companies had been after as well. This will create a more than $50 billion company. That's the tagline we're using because it's hard to quantify, I guess, exactly how much Anglo is paying or what the premium is. It's like 17%, but Anglo is also paying its own shareholders kind of to approve the deal, and that zeroes out the premium. It's pretty complicated. I highly recommend you check out the story, but it is essentially still one of the biggest deals in mining in over a decade. So that's one that's in focus for us. We are back with Allspring's global head of equity investments, Ann Miletti, on a day when we could again hit a record high. And you did tell us earlier that you think caution is maybe warranted on the index level. It does look like the economy may slow down, like even earnings growth may slow down, right? The jobs picture isn't fantastic, and because of that, we're going to get a cut from the Fed in September. Is that a good thing? And do you think when we get Fed cuts, is that a reason to buy or be bullish, or is that a reason to worry?
It depends on the underlying issues, and I think you hit on it with the job market, and that's what we're paying close attention to. There are signs of some cracks there, and we need to watch that closely. And so I think it is, you know, how far will the Fed cut, and will it be quick enough before the job market really does show signs of rolling over or something worse? And so I'm relatively optimistic on the overall economy here. As you said, there are a lot of positives. And more importantly, from the bottom up, as we analyze company fundamentals, what I hear from our portfolio managers is company managements tend to be pretty optimistic about the future and their ability to manage some of these things that have kind of popped up. Tariffs and other things have been pretty good. And so with a lower interest rate...
Well, better than expected.
Better than
right?
accepted.
I mean, when you say there are a lot of
expected,
positives...
Yes. Yeah.
Are there really a lot of
positives?
It seems like there's so many negatives. And I don't know if that's because I worry as a skeptical journalist, right? But there's so many issues here. We have tariffs that are, 8 times higher than they've been in 100 years? Yeah. We have uncertainty that seems to be also like off the charts right now. We have a jobs market that's really slowing down and a labor pool that's shrunken drastically. I mean, it seems like there's so many more negatives than positives.
Look, Matt, I don't disagree with any of those things. And you and I, Dani, we all have to live by these headlines every single day. But the rest of the world around us is kind of coming in, and they're seeing some things that are interesting. We're headed into likely what is to be a lower interest rate environment, less regulation. Also has been a
point. Ken Griffin also says that's the most important aspect of this administration.
And so when company managements are looking through at these things, they're kind of weighing the negatives and the positives and how they're able to manage into the future.
And I mean, it sounds really active what you're doing right now. Looking at what company management is saying, and to that point, I just wanted to bring up something Torsten Slok of Apollo said today, and I say this with full knowledge that he works for a private capital fund, not an active manager, but he wrote today, combined with the domination of passive investing, failure of active managers, and high correlation in public markets and high concentration in a few stocks, the reality is that there is no alpha left in public markets. What would you make of that?
You know, the one thing I do agree on is there has been a structural shift happening in the market, and that is more concentration in the indexes. That has made it more difficult for active managers. However, at this point in the cycle, when you have so much concentration, what I think the benefit of being an active manager is that we're able to diversify the risk and really think about risk versus reward every single day for our investors. And I'm a big believer that when this current cycle, shows signs of deteriorating and you have that breakdown in concentration, active managers are really going to shine.
Well, one of the things you can do really well as an active manager is find where the AI winners are that aren't priced in. And you look at a deal like today, Nebius. Honestly, Matt, when I saw the deal, I was like, who? Yeah. Who is Nebius? What is this company? How difficult is it to find winners? What does this deal show us about kind of the learning curve of understanding who is benefiting from this and where you could actually see some real stock market
and to be fair, Allspring was pretty early on the AI trade.
Yeah.
I mean, pretty early on the big tech trade before many of the other shops on the street came out for that.
Yeah, and we're still a big believer that we're in the early stages of this innovation cycle. But what we're spending time on now is looking at what the next phase goes to. And the benefit for me is I started my career as kind of a TMT investor. And if tech, media, telecom, for those that don't remember, and, there was kind of like, you were not the most loved on the street if you were doing that. And then all of a sudden you became in vogue because that was the best area to be. And then it shifted. And whenever you're living through a big innovation cycle, there is a phase up front where certain areas of the market really do well before that broadens out. And if you think about what the internet did, it really broadened out across all of the economy. AI is doing that now. And so it's not that difficult for our investment teams. And that's what they're spending time on, is looking at innovation cycles and where the next winners are going to be.
By the way, I started my career as a TMT reporter. So my first job was covering the UMTS auctions, the Vodafone purchase of Mannesmann. And I thought yesterday was so fascinating to see SpaceX buy that spectrum from EchoStar. They'll be able to offer, they already do, but they'll be really able to offer direct-to-device communications. And I thought, it's cool that this private company is using its shares as currency. They don't have to go public. And there's so many big private companies out there. What do you make of that as someone who now, you're in charge of public markets, but in your career, this is your industry, right? And a lot of the big players are private.
I mean, it has changed. As we talk about structural changes in the market, it has changed the dynamics of what's going on. And not only are they involved in some of the companies that are really strong, like a SpaceX, but they have changed the market dynamics on the weaker side of the market as well. I mean, I was just talking to somebody earlier about the lack of bankruptcies we see. As I talked about the small cap space, I mean, in some ways that's been a disservice, right? There was a survival.
There's no good companies left.
Well, there are. I think
there
are in the small cap space, but what they're diluted by companies that wouldn't have survived in the past. And that's a challenge, I think, for small cap managers today. Again, not so much on the active side, but if you're passively investing in an index, you're exposed to some of those lower quality companies as well. Again, the benefit of being an active manager today.
So we're going to clip this up, send it to Torsten Stock, and let him know that alpha still exists in the markets. How about that? Thank you so much for joining. Really great to have your thoughts this morning. Allspring Global Head of Equity Investments and Miletti. Let's get you check on that equity market right now, because you are looking at a gain. I do not believe this quite puts us at a new record high. I don't know.
Does it? It does.
Okay.
If we close at this level.
I stand corrected. Here we go. If we close at this level, we will indeed be at a record high at 6503.33. What's going to lead us there? It is the big tech players, Microsoft and NVIDIA. They're leading us just because they're such big weights. United Health, that's on specific company news that they have 78% of their customers in this higher premium group that gives them refunds, rebates when it comes to Medicare. If you look to the downside, This is kind of interesting. We have that big Apple event today, and we are negative on Apple ahead of it, only by 0.5%. But again, one of the top 5 biggest weightings in this equity index benchmark. So hence you get it dragging down the overall index. Now, when it comes to the sectors themselves, a somewhat even split. Energy, the best performer, up 1.3%. Just looking at it, you do have some more of the safer kind of companies that are outperforming. So healthcare, for example, Teck, that continues to do well. You saw that on the screen before. Dragging us down is materials. By the way, I'm guessing part of the reason you see energy doing well, maybe Teck is included in the energy benchmark. It might be too small, but some of these big deal news flows may be moving things around as well, Matt.
Yeah, absolutely. A lot of these indexes are full of companies that you may not expect. All right, coming up, investors await Apple's biggest event of the year. I think consumers, it's safe to say, are awaiting it as well. We're going to discuss all of what you can expect to get and more with Michael Wolff. He's a legend in the tech and media industry, and he joins us next on this Bloomberg Open Interest.
Get you some top calls, some of the analyst action in focus this morning. First up, Dick's Sporting Goods getting raised to a buy at Citi after the close of its Foot Locker acquisition. The company says, the firm says that the combined company will be a, quote, powerful force in athletic footwear and apparel. Those shares up 1.2%. Next up, Roblox getting rave reviews on Wall Street following its developer conference last weekend. Wedbush calling it the most compelling growth opportunity in the video game sector. JP Morgan sees healthy upside potential, and it's getting a boost to its price target from BTIG. Shares up 2.5%. Finally, Lululemon getting a cut at KeyBank Capital Markets. The firm citing increased competition in the Lulu market and a softer outlook for the U.S. shares, still up just barely 0.5%, Matt.
All right, so there are some of your upgrades and downgrades in stocks to watch this morning. Let's talk about one of the biggest of all. Apple is set to reveal its latest lineup of tech ahead of the holiday season. The Mag 7 staple, using the tagline awe-dropping for the event, which is kind of a fun play on words. The phrase doesn't necessarily make a lot of sense, but I get what they're saying. Joining us now to talk about this is Michael Wolff, Activate co-founder and CEO. Michael essentially invented media entertainment consulting. He ran MTV, a legend in the industry, and we're really glad to have you on. Michael, what do you think, first of all, about, the products Apple is releasing? We've all grown sort of addicted to this ecosystem, but
everyone
there's
has
not
them in
a
their
lot
pockets.
of innovation coming out, right?
I mean, look, this is every year. It's New Year's in September for Apple. I mean, recognize that the upgrade cycle has less to do with large innovations, and a lot of it just has to do with people want the latest. Our research shows that a third of Americans are keeping their phones less than 2 years, for less than 2 years and then upgrading. And yes, there are a number of features. There's the 48 megapixel camera. There's liquid glass. I mean, part of what's making this interesting is a lot of it's more on the features that are not those central to that historically. So, for example, Apple's making a major push into healthcare. So you've got 4 new phones, 3 new watches, all this rumored, as well as a new set of AirPods. And they all have new sets of health features.
So if you have an Apple customer that is sticky, Michael, and they're upgrading within less than 2 years, and they just want the latest and greatest, it doesn't matter how big the innovation is, does that change as Google zooms ahead, as other phone providers zoom ahead with their AI offerings?
It really doesn't change. And really, we have a contrarian view about what's happening with Apple and Apple Intelligence. I mean, if you look, there's a lot of negative voices about Apple saying Apple's been left behind. In reality, when you look at the things that Apple can do with Apple Intelligence today and what they're rumored to be able to do, it's everything from image generation, document help, organize my life, live translation. Most of those things you can do, and not only that, Amazon, and yes, their Amazon may be left behind, but Apple isn't. And so if you consider Samsung And Google's phones, there are a number of things that they can do. For example, circle to search on Google. But in reality, most of what Apple can do with Apple Intelligence is what people need. The difference between them isn't really going to shift share. Right now, Apple has about 16% global share, Samsung 19%. It's going to be pretty steady. And the numbers in the US, over 50% of American phone subscribers have an Apple phone, and Samsung's about 30%. So Apple has historically been a late follower. They've let other people be the pioneers who get arrows in their backs. And this privacy feature is going to become very important. Everything is on device. They don't need you to go off somewhere else to Perplexity or ChatGPT. So that's going to be a big issue for consumers. Apple has a lot going for it.
This, though, Michael, is what I wonder if they're just leaving something on the table. Obviously, I'm doing everything on an Apple device. I have the MacBook, I have the iPad, I have the iPhone. But I'm using ChatGPT to speak with instead of Siri, right? I'm using ChatGPT instead of Safari or Google, frankly. And it would be better if Siri would answer even the most elementary questions, and she's still not capable. Why is that?
No, she's not capable, but she will be. And once again, Apple has never been the leader in the latest cutting edge functionality. When they're playing a great move by letting everybody else go first. It's not going to change which phone that they choose, and then it's all tied to their ecosystem. I think we're going to be surprised by how much farther Apple's going to go and really leapfrog the others.
All right, great to get your take. Hope we can get you here on set when you're in New York. Michael Wolf there of Activate coming to us on Apple, the big launch in Cupertino. Ed Ludlow there. He'll be covering it for us all day long. Now, coming up, Israel said it carried out an attack against Hamas leadership. We'll have more on this developing story as the IDF moves into Gaza as well. This is Bloomberg Open Interest.
Israel says it has conducted a precise strike targeting the senior leadership of the Hamas terrorist organization. Let's go straight to Jomana Bersetchi, Bloomberg's host of Horizons Middle East and Africa. She joins us from Dubai. Jomana, what do we know at this point?
Yeah, Dani. So about an hour ago, explosions were heard right in the center of Doha, in the cultural center, a part of town called Qatar. Initially, it was not clear what exactly had happened, but about 20 minutes after footage showed quite clearly that smoke was coming out of some of these buildings, the IDF put out a statement saying that they had specifically targeted senior members of Hamas leadership, members of the negotiating team, still not confirmed yet who exactly was targeted in that blast, but they also accompanied it with a statement saying, for years, these members of the Hamas leadership have led the, quote, terrorist organization's operations and are directly responsible for October 7. Now, the Qatari Foreign Ministry were very quick to respond. Dr. Majid Al-Ansari, he is the spokesperson for the Ministry of Foreign Affairs, put out a statement very strongly condemning this attack, saying that this criminal assault constitutes a blatant violation of all international laws and norms. And a couple of minutes ago, we also just got a post put up on X by the UAE Minister of Foreign Affairs, as well, an advisor to the president over here in the UAE, also saying that the security of Arab Gulf states is indivisible, and we stand heart and soul with the sisterly state of Qatar condemning this attack. So you're beginning to get the first response out of these UAE nations. And of course, it should be said that an attack like this on Qatar is unprecedented in nature. What you had back in the Iran-Israel war was somewhat of an orchestrated attack. You'll remember on Al Udeid base, administered by Iran. Qatar, in that circumstance, were given advance notice. This is a very different situation today and really takes this to the next level. What I would say is the backdrop to all of this is Israel has been expanding the offensive in Gaza City over the last couple of days, targeting high-rise buildings, issuing evacuation orders. But at the same time, you will recall that on Sunday, President Trump also said that it is time for both Hamas and Israel to get a ceasefire deal across the line. He also issued a very thinly veiled warning to Hamas saying this is their last chance. This is their last warning. They have to accept the ceasefire deal that is being proposed to them by the U.S. And so this is the latest development, still trying to figure out who exactly was targeted. But the response from Qatar and from Gulf states has been quite unequivocally condemning the actions that Israel took today in Doha.
And it is really fascinating that they move into Doha, that they take this there. But I wonder what we know about Gaza. As you mentioned, they have evacuated or told about 1 million Palestinians to leave Gaza City. What do we know about that IDF operation?
Yeah, so it's unclear at this point exactly how many residents have evacuated Gaza City. The latest that we know per the latest reporting is that only 100,000 residents have managed to evacuate. There are still about 900,000 residents still there. In terms of the ceasefire proposal that was put forward by the U.S., reporting does suggest that some of the terms of the deal would include the release of the 48 remaining hostages, both deceased and alive, in exchange for 3,000 Palestinian prisoners. But then also one of the other terms of the proposal would be for Israel not to go in fully and to conduct a full operation in Gaza City. But of course, it is unclear at this point whether Israel have actually signed on to the terms of the agreement. And we do know that the offensive continues.
All right, Jumana, thanks very much. Bloomberg's Jumana Bercecci there reporting live on the attacks in Doha. You can follow all of those developments on real time with your Bloomberg terminal. Just type TLIV, go. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Moments away from jobs revisions with an equity market treading water.
Yeah, we are, though, treading water near record highs, right?
Yep.
So if we closed at this level, we would be at a record. And I think a lot comes down to what we see with this number that's just about to cross our terminal. Breaking economic data. There are revisions to the Bureau of Labor and Statistics data for payrolls. We're expecting a drop again. Last time we saw a drop of 818,000, and wow, this time we get a bigger drop. Let's get over to Michael McKee right now, Bloomberg's international economics and policy correspondent, with the numbers. Mike?
Well, it looks like a big miss in terms of the upside. We're down 911,000 jobs from what we anticipated last year. This is through March of last year. So there were 911,000 fewer jobs in America in March of last year, and that's for the 12 months that go back from there to April of 2024. Does it mean a lot? Well, it would mean something if it really stayed that way. We do anticipate some additional changes to it before we get to the release of it in January, the final release in January, in the January employment report. What this means is about 76,000 fewer jobs a month were created in that year from April 24 to January to March of 2025. Shows the economy was weaker than anticipated. We don't have a month-to-month breakdown. We do know that this is just for that 12-month period. Once we get the January final revision, then they'll break it down by month. But essentially, at this point, we're looking at a much weaker economic picture for the labor market over the last year or so.
So just looking at the market reaction, Mike, you get an S&P 500 that still remains little changed. It's basically flat, as is the NASDAQ. The real move potentially in this bond market, where yields have been moving higher, now those are also unchanged. So giving up some of those losses for at least the front end of this curve, turning into very, very slight gains. Mike, if this means that the job creation, the job growth starting last year was a lot slower, again, this is backward looking through March. Does it change anything for the Fed here today for the decision coming in September?
No, it doesn't, because the Fed knew that we were going to have a revision, and they knew it would be large. They didn't have the exact number, but they knew that the labor market was weak. And remember, last summer, in the months leading up to the September 50 basis point rate cut, the Fed saw and said the economy, the labor market was weakening, which is why they went 50. So we don't, as I mentioned earlier, have the monthly breakdown, but it does suggest that the Fed was correct in its diagnosis of the economy at the time. Now we have to figure out what does it mean going forward in this September, but we don't have any data between that would contradict what we've got between March and now. So they're looking at what's happening now and going forward rather than what happened essentially months ago.
All right, Mike, thank you for breaking us down that number again, much bigger than expected. 911,000 is the payrolls revision. Joining us now is Jitania Kandhari, Deputy CIO of Solutions and Multi-Asset at Morgan Stanley Investment Management. Jitania, thank you so much for joining. So look, this is much weaker, and it suggests that some of these months may even look negative, that you have a big deduction in each of these months, especially in the summer of last year, heading into this, even before you had some of the chaos of April 2nd. Does it change how you view this economy if we've had such a big revision to the downside for the jobs data through March?
Our expectation has been for a slowing in this quarter because the last quarter US GDP was growing at 3%. You had a lot of front-ended buying of all the tariff-related goods, so we were expecting a slowdown, I think 1.5% for this quarter. So that doesn't change. I think it's important to keep in mind that the Fed policy with respect to this slowdown is going to be a fine balancing act because on one end, core PCE, our expectations are that it remains sticky at 3% by the end of the year, given where we are on the inflation trajectory. And on the other end, you have cracks developing on the growth side.
You know, yields came down briefly. They're back up a little bit. Nonetheless, I am shocked when I look at the 10-year, less than 4.1%. And if this continues, right, we're going to get down, it feels like, to below 4%. What does that mean to you for stocks?
Yeah, you know, I think the one thing to keep in mind is that inflation is above target. When was the last time in history that Fed cut rates when inflation was above target, right? It was during periods of stress, systemic crisis, 1980s with the oil run-up, in the 2008. In 2019, interestingly, inflation was slightly above target, but Fed had rate cuts, which were more preemptive. So I think that can happen even this time, of course, with continued vigilance on the inflation side, and that can be overall supportive because typically over time when Fed cuts rate, the 10-year will also yield lower.
Yes, well, that's a great point because the most recent cutting cycle that we saw from the Fed saw rates rise as the Fed brought the front end down. So do you expect that to happen again?
No, I think that, you know, the steepness will remain in terms of the yield curve, but I think that should bring the longer end down as well. And also we have to keep in mind that we are living in a indebted economy, of course, this time driven by the public sector, and you really need that nominal GDP to be growing faster than the nominal interest rates. Otherwise, there will be an accident. So kind of that economic balance has to be maintained with the way the interest rates will react to the growth environment.
I say you sound like a lot like your colleague on the other side of the house, Mike Wilson, who's been arguing that we're going to run this economy hot to grow our way out of the debt. If we are in this scenario where you're running this economy really hot, you're getting fiscal spending at the same time that you get a Fed that's cutting, does it mean that figures like this week's CPI just don't even matter? That we're going to be getting cuts, the labor market is weak, and the inflation figures, as their importance for this market, kind of go to the wayside? Yeah,
I think we, as I said, like, you know, the 2019 parallel, we may get some cuts, but I think the Fed has to really maintain that inflation vigilance. So we really have to keep that in mind, you know, to understand what the market's pricing, because at the end of the day, the markets will be a reflection of what's happening versus the expectation.
Just because we've been pricing in so many cuts, is this market prepared for a hot number of CPI this week? How big of a risk event is it?
I think a CPI, a core PCE of 3% is in the estimates, and I don't think that that can really derail the story. But if the if it continues to get hotter, not our base case, because interestingly, if you see on the services side, which is on the rent component of CPI or even real wages, those have been trending down. So I think there are offsetting factors here, and the big upside can come from the AI productivity and what that means for inflation. So at this point, I think we seem balanced. To expect further cuts from here, I think, would be a little bit of a risky proposition.
Jitania, I want to ask, after having lived in Europe for many, many years, and I have a very international family, I pay a lot of attention on the WEI function to what's going on with other national indexes. And this year, it's striking to me to see double-digit gains, even 20% gains, or in the case of Madrid, 30% gains on international exchanges. So much stronger the gains than we see here in the U.S. Only 10% on the S&P and like 6% on the Dow. Does that continue? Because for so long, it's almost like small caps. For so long, we waited for Europe to outperform. Now it's doing it, or has done it. Is that now in the rearview mirror?
I think the important thing is, in those returns you talked about in Europe, nearly half of that came from the euro, from the currency. So it's really important.
No, I'm looking at only year-to-date changes. So the DAX is up 18.9% year-to-date. If you factor in the currency, that's a 35% gain.
Yes.
The IBEX 35 up 29% year-to-date. If you factor in the currency, up 46%. So even without the exchange rate, they've been crushing it.
I think the point I'm trying to make is the euro is a strong correlation with European markets.
Yeah.
And the view on the dollar weakness, it will manifest in international equities, Europe included, because now as you're seeing the growth inflecting downwards in the US, growth in Europe with some of the industrial activity and PMI is inflecting upwards. So also in other parts of the world where monetary policy is actually supportive now, and many countries in the developing world have fiscal situations much better than the Western world, and those are countries that will have monetary and fiscal impulses. So several pockets in the international space, Europe included. Again, you have to make a distinction between core and peripheral Europe. There are different, it's very heterogeneous.
And forget about France.
Yeah, that one we are really cautious on, because I think this lingers. The budget deficit doesn't get cured so soon. Have to keep an eye out on what implications that has for the euro as well. But I do think that the ECB backstop will be there in case we reach a crisis-like situation.
Great having you join us here. Hope we get you back soon. Jitania, thank you so much. Morgan Stanley's Jitania Kandhari there. Let's get a look at some of the single stocks moving in this market right now. Shares of Teck Resources are soaring after Anglo American agreed to acquire the Canadian miner. You can see, though, that they're up less than 14%, and the premium ostensibly was 17% before you take into account the money that Anglo gives back to
Well, it's this
shareholders.
idea that this deal isn't done, right? There have been so many people interested in both Teck and Anglo, let's be honest. So maybe more bids come in. Maybe this deal doesn't go through. Another one of the big deals of the morning, Nebius Group, up 36%. It announced an AI infrastructure with Microsoft worth, I think, about $19 billion. Yeah, $19.4 billion. And Matt, this was a company that once was Russian. It was sanctioned. It was left for down in the dumps, but then it spun off those Russian assets. And here is the glorious comeback.
Yeah, and then Apple, it is down right now, but as we've been reporting, it's up about $500 billion since the end of July. Investors may be buying the rumor. The question is, will they sell the news as we get the big product announcements out of Cupertino? That starts at 1 p.m. this afternoon. They're expected to announce, well, a new iPhone 17 lineup, as well as other new devices. Ed Ludlow is out there in Cupertino. In fact, he joins us now with the preview. So, Ed, just to give the sort of consumer angle, what do we expect on the iPhone 17? What are they launching here?
Yeah, the basics are it's a range from an iPhone 17 base model through to a Pro and Pro Max, following the pattern of recent years. But per Bloomberg reporting, somewhere in the middle, you have iPhone 17 Air, Apple's thinnest ever phone, 5.5 millimeters of thickness, 6.6-inch screen. At the Pro end, Pro and Pro Max, developments on camera, battery life, all the factors and features that resonate with the consumer, the timing critical, when the handsets become available, if it's within this fiscal fourth quarter or in the holiday period of the fiscal first quarter of the following year. Apple right now is zeroed in on hardware, and all of the reporting suggests if you are tuning in because you want to hear more about Apple Intelligence or a revamped Siri, don't. But as Bloomberg's reported, that will come in the spring next year with a wider offering on Siri. I think tariffs and pricing is going to be a story here either way. If Apple doesn't raise prices on aggregate overall, that is a story. If it does and passes it on to the consumer, that's a story. But then you bring in the carriers. What will they do? Offering trade-in deals or other kinds of incentives and discounts. It is an interesting one with the backdrop of what Tim Cook is trying to do with the administration right now, re-onshore more of the supply chain and look at its supply chain around the world. The final feature is probably to think about this as a stock story. In the moment, it's likely to be a sell the news event. It always is. But look at the Bank of America research from August 25th. Look at the Bloomberg terminal. Often, where a handset resonates with a consumer audience 30, 60 days out, this is a stock that outperforms. And so that's what we're watching for, not necessarily in the moment, but the timing of the release, the pricing, and how this does going into the holiday period. High-end watch with satellite connectivity at bigger screen, taking on Garmin, that's an extra bonus thing to watch for. Otherwise, classic Apple, 1 p.m. Eastern Time, 10 a.m. local time. Join us.
We are very much so looking forward to that. That is Bloomberg Tech's Ed Ludlow. And again, he will be walking you through those numbers at 1 p.m. And if you are just joining us, about 13 minutes ago, we got the latest revisions for jobs, 911,000. Matt, that is the worst ever payrolls revision in 26 years of Bloomberg data history, and stocks are higher.
Yeah, well, because this is so rear looking, right?
For sure.
I mean, as Michael McKee was pointing out, this data doesn't even come to the last few months. So it's just revisions for where we've been. And we already know that the Fed is likely to cut in the future. So that's what the market seems to care about right now.
Yeah, and even yields higher. So not a lot of changing after the data. Here's one thing that has changed or is hoping to change. We're going to dig into the details of Anglo American's deal to buy Teck. Those shares up more than 13%. We will get into what this could potentially mean for the mining industry. All of that's coming up on Bloomberg Open Interest.
Now to high interest, look at what's making headlines around the world. Israel conducted a strike against senior Hamas leaders in the Qatari capital of Doha. The move escalates an already tense standoff in the region. Israeli Prime Minister Benjamin Netanyahu's office says the attack was wholly an Israeli operation. Al Jazeera cites Hamas in reporting that the leadership delegation has survived the attack. You can follow all of those developments on TLIV Go on your Bloomberg terminal. The Chicago Bears are planning to move out of the city that has been their home for over 100 years, with the team's owners foregoing state money and deciding instead to build a new stadium in the suburbs. The Bears CEO says the move out of the city means the team is expanding, not leaving. The announcement was made just hours before the Bears' season opener against the Minnesota Vikings, and as Chicago waits potentially for President Trump to send in the National Guard.
Yes, a lot happening in Chicago. Let's turn, though, back to one of our top stories this morning, Matt. Anglo American has agreed to buy Canada's Teck resources, creating a more than $50 billion company and one of the biggest mining deals in over a decade. Joining us now is Varun, Sikka, AlphaValue Metals and Mining Analyst. Varun, great to see you. And look, this makes sense, one could argue, from an Anglo point of view. They get a hold of those copper assets, which are just so highly valued. Does this make sense from a Teck point of view in a deal that's being labeled as zero premium and potentially undervaluing them?
Well, thank you for having us over. And in terms of this deal, we feel that it's a win-win for both firms' shareholders. And the point worth noting is the fact that copper is a very big focus area for both the firms, and that's something that strategically aligns both firms' leadership teams. And from an Anglo standpoint, it is a good deal, but even if you look at it from a Teck standpoint, it isn't that bad an exit, given that both the firms had been subject to hostile takeovers in the last 2 years. and they've been battling their own fair share of challenges, including restructuring and wanting to get rid of unwanted assets. So in that sense, we feel that it's a win-win for both firms, which somewhere also reflects in the share price reaction that we are seeing for both the firms.
There are clauses that allow either one to go with the bigger offer if it comes from outside, and we know that other companies have been interested in both of these firms. Do you expect a bidding war to erupt here?
In our opinion, that's unlikely to be the case because, see, if a bigger miner, say like BHP or Glencore, was to revive their acquisitive interest in either of the firms, they'll end up paying a lot more than what has been put on the table right now. And secondly, they would have their own agenda in terms of wanting to get rid of some of the unwanted assets. So as an example, in case of Anglo American, they're still struggling to kind of get rid of their diamonds business, which is De Beers. And the fact that Peabody pulled out of its recent decision to buy Anglo's met coal assets, that's also a setback for them. And if we kind of come back and see Teck Resources, just about few days ago, the firm acknowledged that it's kind of pausing its growth ambitions, primarily because it wants to kind of address bottlenecks at one of its flagship mine in Chile. So in that sense, both firms have their fair share of challenges, which, if they come together, can perhaps be better addressed vis-a-vis them being acquired by any other mining biggie.
Well, Varun, on that De Beers stake, if I can ask you about that, isn't this literally the worst time to be selling a diamonds business with the value of diamonds plummeting, with lab-grown diamonds coming up in popularity? They want to get rid of this asset. What could they even get for the thing?
Well, the thing is that, as you rightly said, the lab-grown diamond is a very big phenomena that is disrupting the conventional diamond industry, and which is why Anglo American wants to get rid of it, even if it has to be at a fraction of what it is actually worth. Because see, if they were to kind of try and address issues in De Beers, that in a way eats up the strategic bandwidth of the management, which can perhaps be utilized better to build their copper business, which is a far more stronger business in terms of margins and in terms of volume uptake.
What is your take on the diamonds, the natural diamonds versus the lab-grown diamonds, Varun? Just for clarity, because we talk about those lab-grown diamonds a lot on this show, and there seems to be a real divergence of opinion, especially internationally, about the importance of real versus man-made real.
Well, in terms of the demand for lab-grown diamonds, that has definitely been going up, especially on the industrial side. But yes, on the precious, say on the jewelry side, demand for diamonds pretty much remains, and which is why we always expected some of the leading luxury jewelry brands like LVMH perhaps emerging as a suitor for De Beers. But the fact that luxury spending itself is kind of facing a lot of uncertainty because of slowing China, which is perhaps the reason why Anglo has so far struggled to find a buyer. So there's high likelihood that the government of Botswana buys out the remaining stake from Anglo and they kind of take it private.
Oh, Matt, did you say for clarity, was that a diamond pun?
That was not a pun, but no pun intended, let's say.
It was great.
It worked out perfectly.
It was great if you did intend it. Varun, okay, let's get back to not just diamonds, but to copper with this deal. I mean, this creates a copper powerhouse. What does this mean for the industry, for the smaller mining players?
Well, in terms of pecking order, after this merger goes through, Anglo Teck should emerge amongst the top 5 copper producers with annual production capacity of roughly about 1.4 million tons, which is not very far away from the highest copper producing name, which is BHP as of today. So in that sense, they definitely emerge as one of the largest and most prominent copper names. And in fact, they end up being even bigger than the likes of Rio Tinto, which is quite a startling development.
I wonder what other M&A you expect here, Varun, because it seems like the stage is set for more consolidation. Who's next?
I think in terms of consolidation, ideally we would have expected that BHP comes back with a revised offer for Anglo American, but that has not really happened. And somewhere it's also a blessing in disguise, because if they kind of get into a bidding war, BHP would end up paying more or putting more money on the table, and instead of diluting their own shareholders, they would have taken up debt to kind of finance that deal. So in that sense, I think BHP is better off managing its own copper asset as of now. And yes, they can go ahead and look at other struggling or not so well performing marginal copper assets. There are lots of them in Canada. So in that sense, there could be a lot of M&A action, and the fact that this deal happened in a trade war era, a cross-border deal happening, is kind of a very promising development in that sense.
All right, Varun Sikka from AlphaValue, where he's a metals and mining analyst. Thank you very much for your time. Really appreciate it. Last minute as we got this breaking news of the deal this morning. Let's get a check on what's going on in markets right now. You've got just a very slight gain on the S&P 500, 64.98. So not enough for a closing high and certainly not an intraday high. Coming up, Elanco Animal Health CEO Jeff Simmons joins us next to discuss the company's robust drug pipeline. And we're going to ask him why pets are getting so fat, too. This is Bloomberg Open Interest. Animal health company Elanco announcing its fastest ever blockbuster drug. Its latest parasite innovation for dogs reached $100 million in sales in less than 8 months. Meanwhile, one of its other drugs just received approval from the UK's Veterinary Medicines Directorate. Joining us now is Elanco's CEO, Jeff Simmons, to talk about this quickly growing industry. Thanks so much, Jeff, for coming on set with us.
Great to be here.
Talk to us about the growth that you see, because the pet issue became even bigger during the pandemic, but I think any of us with pets would spend pretty much whatever it takes to keep our little buddies healthy.
The willingness to spend on a pet, even in the younger generations, never been stronger than it is now. You know, as maybe the less kids, more disposable income, that energy is going towards the pet market, and it's for all issues. And what we announced yesterday was the biggest market, $6 billion market out of the $40 billion industry is parasiticides, ticks, fleas, heartworm. But this pill being able to have 4 active ingredients, Credelio Quattro, which we talked about last time I was on the show, is the fastest growing segment right now. People want a solution. It's easy. It's something that's taken monthly. It takes care of all the issues, and it's growing rapidly. And so we're excited about this as one of actually 7 blockbusters that's really driving the movement in Elanco stock and our growth.
Does it cannibalize some of the other Advantage or Seresto or the other drugs that you have for similar issues?
Actually, very little. We've got actually Seresto Advantage is really for the 1/3 of pet owners outside of the vet clinic that don't go. About 1/3 of pet owners either don't have access, affordability. So when we acquired Bayer, that's for the OTC brands. We're #1 in that market. That market's growing nicely. And then this is actually for in the vet market parasiticides. So we've done a nice job of segmenting and separating those products.
Which, by the way, on that point, Amazon had started an online pet pharmacy. They acquired someone in order to do this. You say people won't go into the vet, but is it changing now because you can just pick up a phone, apparently go on Amazon.com, get a consultation through telehealth, again, kind of mirroring what humans are able to do at this moment? How does that change the demand?
Yeah, I'll emphasize there's a real connection to the vet, and the vet's still really critical. It's making that vet, and the majority of pet owners still do go to the vet, but it's making it more accessible and easy. And I think COVID really drew that. I mean, whether it's telemedicine, drop shipping, I even say to my wife with our Labradors, hey, get that pill, delivered monthly to the door so I remember to take it. And probably one of the 2 biggest drivers right now in pets, besides just, more innovation, is, a globalization. There's fewer homes with pets outside, but that humanization is happening outside the U.S. faster than inside the U.S., and then making it easier. Compliance. If a pill is supposed to be taken monthly, on average 5 years ago it was 4 or 5 a year. Now it's increasing significantly.
My Wegovy will be delivered monthly to my door. And Dani pointed out to me that pets are getting fat.
Yes,
right?
the study I read, 33% of cats are classified as obese and nearly a quarter of dogs. Jeff, that's a lot of overweight pets.
Well, and it seems like an opportunity, especially you spun off from Eli Lilly. They have Zepbound and Mounjaro. Are you going to offer something similar for GLP-1s for cats and dogs?
We are going after, really, if you look at on the pet side, a lot of the same problems happen on the on the pet side. So what I will just tell you is 2 years ago, we dropped the first SGLT2 as an oral diabetes product. So that's an example of coming off from Lilly. When you start to look at, other products, derm, whereas we announced we're expanding our derm. So you've got the whole autoimmune area. So aging pets have aging people problems. Pain is one of the fastest growing markets right now. And so, yes, we'll be targeting, areas that, everybody wants an active, healthy pet. When I grew up, it was outside. It's come inside. Now it's, on the bed, and it's a big part of the family. So we will be targeting all those. And that's what really, today, there's a lot of stuff talking about the consumer markets and the dynamic up and down. What we see in animal health is pets and protein. I've been in this industry almost 4 decades, and I've never seen really the tailwinds behind the trends. The willingness to spend on pets, the globalization of pets, the humanization. And then on the protein side, I had a long conversation last night with, food experts here in New York City about the movement of protein. I mean, dietary changes to the requirements that are out there. And right now, we've talked about cottage cheese and dairy to the meat sticks. It's the fastest growing meat segment. We are benefiting from the 2 Ps, pets and protein, in a big way.
Oh, God, everything has protein in it, Jeff, and now it's pet food, too.
Hopefully, right?
Hopefully everything is
You
protein.
need that protein, because if you're taking Wegovy, right, you can't waste your calories.
If you're
on
having cat Wegovy, you have to have protein. Jeff, just super quickly, because Matt mentioned COVID, everybody bought pets. They're getting older now. They're maybe having separation anxiety because everybody has gone back to work. How have the demands changed on what people want to medicate their pets with? And again, just about a minute here.
Yeah, I think it's, as I've said, I think I come back. The big focus right now is on the big problems. So parasiticides, take that off the table as a problem. Biggest market, that's what we announced yesterday. We've got, we think, best medicine in the biggest market. Derm, itching dogs are the #1 reason people go. That's another big one. Pain is the 3rd market. So we're really focusing on the big markets, and then we're really targeting on the innovation side, the emerging as well. And then, hey, leaders in the OTC pet business and leaders in farm animal. Farm animal and livestock, and that protein globally is still bigger than actually pets, and we're leaders in that as well. So,
Jeff, thank you so much for joining. Really great to have you in this morning. Jeff Simmons of Elanco. Matt, let's get a quick check on markets this morning. And we got some serious negative payroll revisions about 35 minutes ago. And at first, stocks reacted by moving higher. Now they are lower, but the question needs to be asked, are they moving lower because of that, or because of what yields are doing? Look at this. You're looking at 10-year yields up by nearly 4 basis points, despite the fact we got 911,000 jobs reduced through March of 2025. Omar Sharif of Inflation Insights points out that we'll probably just get an upward revision next time we get the number. So maybe this figure this morning matters less.
Well, we got a downward revision last time of more than 800,000. This time we get a downward revision of 911,000. I look at the WB screen on the Bloomberg terminal, and when this number came out, yields that had been up all came down. Certainly at the front end, we saw the 2-year plummet, and now they're all back up. The 2-year yield is back up 4 basis points as well to 352, 353. So I think this move higher in yields really across the curve is one of the main concerns for this market.
It could be on oil, too, right? Let's recall oil popped higher over those attacks in Doha to Hamas leadership, and that seems to have coincided with the pop higher in yields and the move lower in stocks.
Yeah, that's right. We're looking at 63.16 for NYMEX crude, 66.97. GLCO GO is the screen for your commodities. So much you can do with this.
It's an
Bloomberg
impressive
terminal.
machine.
Yeah. Let's get a look at what some of the single stocks moving at this hour. United Health is one we flagged early this morning as being one of the biggest gainers. It expects most of its Medicare Advantage members to be in highly rated plans that earn bonus payments next year. That's a boon for its health insurance business. And you can see the stock, which has taken such a beating this year, is up 4% today. It's down now 34% year to date.
Needs that pop. Meanwhile, the succession drama has been resolved. Fox shares are falling 6%. It announced, again, a resolution to that Murdoch family feud. The settlement now gives Lachlan Murdoch, the favorite child, broad control. And the other 3 Murdoch kids will be selling their shares. So maybe that's why we're seeing
They're going to get $1.1 billion each.
Yeah, which is, not too bad.
So if you know any of the other Murdoch kids, be nice to them. The pressure is on for Oracle to deliver another quarter of accelerating revenue growth. driven by spending on AI after it's already seen a 40% run-up of its shares this year. So Oracle results after the bell today. You can see the shares are off there, maybe because the bar's pretty high for what they have to deliver on the close with Romaine Bostick. Still ahead, we're going to speak with Peachtree Group CEO Greg Friedman on what he calls a repricing grind in commercial real estate. Maybe not the pop that we would have expected. And we'll talk to him about rates as well. What does it mean if they finally start to come down? This is Bloomberg Open Interest.
I kind of think they probably should do a little bit more up front, but I don't think that they will. Because, you know, in their mind, they're kind of worried about like the phantom inflation expectation story or, you know, the threat of potential inflation coming from tariffs. I mean, I think those are really secondary considerations at this point, given what we're seeing in the jobs market.
That was Neil Dutta of Renmac on his outlook for the Fed ahead of its next meeting, September 17th. It's widely expected to deliver at least one 25 basis point rate cut. Joining us now to discuss what that means for commercial real estate is Peachtree Group Managing Principal and CEO Greg Friedman. Greg, great to have you here with us at 731 Lex. This is my favorite piece of commercial real estate, right here in Midtown. What does the potential Fed move mean for you? We've already seen the 10-year Treasury come down to basically 4%.
Sure.
If the Fed cuts further, do you expect that move to continue?
You know, it's a good question. I don't necessarily expect it to continue to go down, you know, further on the 10-year Treasury side. I think it's more them cutting rates today would be more sentimental than anything else, because I think the reality is a lot of this is already priced into the market that, you know, the Fed is going to cut rates as it relates to commercial real estate at least. And I think, you know, the reality is the question's more about, you know, where is the Fed going to end up cutting to? And that's going to be a bigger indicator to what happens to long-term rates. Because I think long-term rates are still in a position where you're going to see them stay, you know, higher for longer. And right now, the 10-year being even at 4%, it's almost double where it averaged between 2010 and 2022. And that has a huge impact. It has a huge negative impact on the values of commercial real estate assets.
So but the terminal rate, I'm sorry, I'm looking at WIRP, W-I-R-P,
Sure.
right? Looks like the market is pricing in a little less than 3, more than 275. Do you expect that to be the case?
Yeah, so for the terminal rate, or effectively, yeah, that sounds about right. And if it ends up in that range, I think that gives support for the 10-year to remain in that 4% range. So I don't necessarily see it dropping, you know, much below 4%.
So if we're kind of locked in the range we are here, what does that mean for the rest of this year in 2026 when you have this wave of maturities and refinancing pressures and rates remain high? Are you expecting a lot of pressure, a lot of distressed opportunities?
Yeah, I mean, I think there's going to be a lot of stress. I hate to say distress, but I think there's a lot of stress because these loans are maturing in an environment where the interest rates in a lot of cases are 50% higher than when they were originally originated. And you've got about $1 trillion of loans maturing over the next 12 months. And so I think it's going to give a huge opportunity set for investors like us to come in and provide, you know, preferred equity, maybe provide senior debt financing that stretch, you know, higher leverage financing to help, you know, recapitalize, refinance these assets.
So let's talk about how commercial real estate is priced. You've got the 10-year, the risk-free rate, and then you add a premium to it depending on the properties. So what do you have, and what do the premiums look like?
Yeah, so I think, you know, when you look at risk premium spreads today, you know, they're pretty thin compared to historic averages. You know, historically speaking, it's the 10-year Treasury plus about 270 basis points. That's the average cap rate for commercial real estate assets. You look at, like, you know, a lot of multifamily assets today is trading in that 5% range, and that's like 100 basis points of risk premium spread, so it's pretty thin compared to historical averages. So you could see a scenario where cap rates actually could, even though short-term rates are dropping, or you look at the federal funds rates dropping, you could see cap rates start to expand out if there's conviction that the 10-year is going to stay north of 4% and, you know, the market starts to normalize back out.
So one of the sectors that you look a lot at is hotels. I know you launched a special SITS fund to look at the sector specifically, both in credit and equity. You have exposure there. A lot has been made about the strength at the higher end, about leisure. Certainly all the publicly traded hotel companies are trying to target that. Are you targeting the same thing? How exactly do you look at your hotel strategy?
Yeah, so we're primarily invested in select service, limited service, Marriott, Hilton branded hotels. across the U.S. And so we are seeing softening in demand across the board. So, I mean, there's no question that, the markets soften out. You're still seeing, RevPAR growth across our portfolio, but it's pretty anemic, the growth percentages. You're seeing a rise in costs. Labor costs have gone up, a lot of, this year in 2025. So it's created a scenario where our cash flows are relatively flat or in some cases down. And so that's a real concern within the lodging space, but it also creates a huge opportunity set long term because it creates an opportunity where you can buy into assets at more favorable pricing. And you're seeing within the lodging sector, I would argue that like the true intrinsic values of these assets are probably closer to to a level where it makes sense to buy into the hospitality space versus some of the other property types like multifamily, for instance, where the cap rates, the risk premium spreads, as we were talking about, and the cap rates are super thin compared to where they probably should be trading today.
Don't you see a lot of maybe a little bit more opportunity in equity across the space than in credit because the appetite, the demand for credit is so strong?
Yeah, personally, there's a lot of demand for credit for, investors invest in credit. There's a lot of credit funds, about 70% of our assets under management is credit driven. I think hands down credit makes the most sense for us right now from a risk, when you just like a risk adjusted return basis, credit, we're getting, we're better positioned, we're in a more defensive position, and it's an environment that we're still having a lot of success being able to go out and provide senior debt financing. We're doing a lot of CPACE, commercial property assessed clean energy financing to help recapitalize like this retroactive. Yeah, so we're having a lot of success.
Clean energy still matters in commercial real estate.
It still matters in commercial real estate, surprisingly, because it's been something that's been very polarizing just from a political perspective. But like we just did a project recently where we financed the Rio in Las Vegas using retroactive CPACE to help effectively provide rescue capital to help recapitalize that project. And we provided $176 million of financing through the CPACE, through a CPACE loan, effectively to help pay down the senior loan. So it was a pretty, successful recap.
Very interesting. Greg, thank you for joining us this morning. Thank you for your time. That's
you.
Greg Friedman, Peachtree Group Managing Principal and CEO. Coming up on the show, the succession drama around Rupert Murdoch's media empire appears to have come to an end. We're going to have more on the end to succession. Spoilers ahead. This is Bloomberg Open Interest. Billionaire Rupert Murdoch and his children have resolved a messy feud with a settlement that puts Lachlan Murdoch in charge of the family empire. For more, Geetha Raghunathan, media analyst for Bloomberg Intelligence, joins us now. Geetha, the messy drama has been resolved, but shares are falling this morning around 6% last I checked. How do you square the two?
So definitely this removes a big corporate overhang, Dani, for the for the stock, I think, and just in general for Fox as well as News Corp. Yes, shares are down. That's just a result of different things that are happening. But I think long term, as we kind of look at the future of Fox, this definitely kind of cements Lachlan Murdoch's leadership, and again, as I mentioned, just clears any litigation or any other family drama overhang.
And this allows them, Geetha, to be as political as Fox historically has been, right? That's the whole point of this settlement.
That is absolutely the whole point. I mean, Fox News, as you know, is very conservative, but also Fox News is the cash cow for Fox. It brings in about 70 to 75% of profits at Fox. It is, Matt, the most watched cable network right now. It has been now for almost 9 to 10 years, more watched than even ESPN. So obviously their political bent, their conservative stance, their editorial direction, all working in their favor. And, Lachlan is the most conservative of all of the kids. And so this definitely kind of preserves that same conservative stance at the network going forward.
Still, linear TV has faced a lot of issues, Geetha. Even though Fox remains the most popular, how does this change the positioning of the company to handle some of those challenges as they come forward?
Yeah, ironically, Dani, I mean, Fox is actually one of the most exposed companies to the linear TV ecosystem, and that's necessarily not a good thing. But somehow Fox manages to be one of the cleanest stories in media, and that's because they've sold majority of their assets, majority of what would be considered their troubled assets to Disney in a huge $70 billion deal a few years ago. They have the assets that are the most desirable right now in television, which is live with news and sports. These are insulated from all of the other cord-cutting pressures that we've generally seen across the general entertainment landscape. And so Fox definitely has the best assets in the portfolio. They have, a heavy exposure to NFL, college football, all of the most desirable assets in media. And so while, definitely media is struggling in general, we still think Fox is very well positioned. One of the things is not only what they did, but also what they didn't do, which is go after, the very expensive streaming wars, which just burnt billions and billions of dollars for so many other companies. They stayed away from that, took a very calculated, measured approach, and that has really served them well.
I wonder about the other successors, Elizabeth, James, Prudence. Certainly, they have had a ton of experience their whole lives in media. And we say the kids because they're the children, but they're not kids at all, right? They're grown men and women here, each getting a $1.1 billion payout. So, and also they're workaholics, not likely to just sit around and do nothing. They're not going to play golf and go on vacation for their whole lives. So do they start something else? Do they go into other businesses? What do you expect from the rest of these people who have grown up in this industry?
Definitely expect them to do other things in the media landscape. I mean, we've seen James Murdoch. He's dabbled in different digital assets. Digital real estate has been a big thing. We've seen all the children, though, kind of take a much more forward-looking view. Remember, this is a company that was built on newspapers, then kind of branched out into cable networks, into broadcast television. We've seen the younger generation kind of be much more forward-looking in their approach, going after a lot of the digital assets, and that's the collection of assets that we see with News Corp. So absolutely, we kind of expect, James, Elizabeth, we know these are very, very savvy business leaders. They are, absolutely bound to dabble, especially with, the 1.1 billion in some new ventures.
All right, Geetha, thanks very much. Geetha Ranganathan is a media analyst for Bloomberg Intelligence. What a fascinating story. I didn't watch Succession.
You didn't? It's so good.
Not all of it. I saw, the first few bits, but which one is Kieran Culkin, do you think? Do we know already? Which one is James? Which one is Lachlan?
Wait, you know what's bad? I watched it,
Which
and I
one is
actually
Shiv?
can't remember. I know just at the end, everybody loses more or less, except Shiv's husband. I don't know. I don't want to spoil it too much. But yeah, basically everyone loses, and everyone comes off horribly. But in this case, Lachlan comes out the winner.
Yeah, well, and everybody else gets over $1 billion in addition to what they had to begin with. So it seems like a good ending. And as I said, I expect a lot more from the others, outside of this. Let's get a quick check on the markets as we finish up the program. We are looking at an S&P that's turned lower and now unchanged. NASDAQ unchanged as well. Coming up tomorrow, Joanne Feeney of Advisors Capital Management joins us. Nancy Tangler of Laffer Tangler Investments, plus executives from Bala Capital Partners, Brookfield Asset Management, and Chewy. This is Bloomberg Open Interest.